Hello, my name is Professor Philip Chang. I'm very honored to give a talk. The title is called Noise Traders in an Agent-Based Artificial Stock Market that we have published in one of the top-tier journal, and with the coders as follow. We have the following four major contributions. First of all, we investigate whether the noise traders can survive in the long term. I'm going to explain the meaning of the noise traders later. And then we have the research on how noise traders influence financial markets, and we investigate how market regulation affect noise trading. We contribute to applications of computational economics and simulation models. And as you know, what motivates us to have this paper? We want to help researchers, investors. We always have the applied research. And a noise trader is a trader who then decides to buy or sell trades in financial markets without detailed professional advice or advanced fundamental or technical analysis. Their role is prominent, as is found out that the noise traders can explain market anomalies. The research on noise trading is meaningful. Our article could be used as a small but new part of the relative literature. The reason was that they normally make a decision based on sentiment or the market news. We having a very in-depth knowledge about the market and the stock analysis. But however, they are also very important because they may influence the way that the markets will be changed. And although previous studies acknowledge the existence of noise traders and influences of the noise traders on financial markets, there are remaining debates on noise traders' precise role in financial markets. For this part, our paper fills the gap of relevant literature to a small extent. Therefore, we then have to know their role and how they influence the market in what ways. With the evidence-based research and agent-based intelligence as a popular technique of computational research is applied in this investigation. The paper also contributes to employing simulation models. It captures the complex micro characteristics of the investors sufficiently, including heterogeneous beliefs and trading strategies. For this part, our paper fills the gap of literature review. And of course, the agent-based intelligence will then provide dynamic and meaningful research outputs through the advanced data analysis. The paper may provide reference opinions of the impact of the financial regulations on trading strategies to investors and regulators, so that we then have to identify what sort of risks they're being involved. Therefore, then it helps them to better propose the new strategies and even the regulation. And the methodology, the market structure, the modeling, and agent-based artificial stock market. There are two assets we are talking about in this paper, bonds and stocks. Mostly, we will then refer to stocks, but however, bonds are also popular options from investors. There are three types of traders we need to know. First, the informed traders. They receive private and informative signals about the dividend and fundamental value of the risky asset. They are rational investors in the market. The institutional investors, they have a learning system, which means that they are usually working for financial institutions who have the many years of experience of doing the trading. They have a very deep understanding about the market, and also they have studied certain stocks over a period of time. Uninformed traders are rational traders who have a learning system. However, they do not receive any private information and hence only update their expectations using public information, such as recent dividends and stock prices. They are experienced traders being trained individually, or people who have attended different type of studies, or even they learn from different experienced trading investors. But they are the ones that have a certain knowledge and they have years of experience. However, they are usually working as an individual rather than as an institutional provider. And the noise traders trade on a spurious signal they believe is correct and informative, while the signal is purely noise. They do not have a learning system, but have a biased belief about the next period stock price as the previous period clearing price, given by the noise term. Usually, there are people who do not have much knowledge about the stock market. They are usually investing due to the hype or a strong belief that certain stock will give them a return. or because of the word of mouth and because of the dissemination of social media. Therefore, they contribute to a certain percentage or the total number of investors. And genetic programming is a technique there to make program evolve and change. Therefore, it's a way there to use as the informed and uninformed traders learning system to help us to understand how they do the trading and what makes them to make a decisions before the trading. And continuous double auction process is employed as the price determination of the paper. Methodology, experimental design. We then investigate whether noise trader activity or the influences on the market will be affected by imposing several regulations. The financial market regulations apply in the artificial stock market are 10% price limit. The reasons are the simulations without price limit versus with 10% price limit, because if it's too low, the impact will not be felt. If it's too high, then it may create other risks. So 10% is usually used as the upper maximum limit before possibly introducing other type of risk. And 0.1% transaction tax, because there is usually adopted by many countries or growing number of countries. It can be because in the form of the administrative fees, or maybe the government will take the tax out of every transaction being involved. And it's just also to reduce the number of transactions. And T+0 and T+1 settlement cycle, which means that it's a simulation of two types of a settlement cycle. So to settle a trade in 0 or 1 day, because when you decide to buy or sell, it usually takes a few days or some time. In the old days, without using the computational finance, we are even talking about 5 business working days. But now, with the rise of the digital transformation, the fintech, and that can be hugely reduced to 0 or 1 day to get everything all finished. So the methodology, model, calibration, and statistics of the stock prices in order to test whether and how the model is reliable and reasonable. A paper presents several statistics of stock prices of the artificial marketing, which after calibrated to basic statistical properties of the real financial markets. So we have actually used NASDAQ, S&P 500, and so on as the way for us to test. So when we use a more well-known and established stock market, then can provide a better reliability to the final result. And then we identify the minimum and maximum logarithmic returns in percentages are between minus 23.33% and 20.15% respectively. And absolute daily returns range from 9.84% to 33.33%. Skewness of the raw returns are all negative, which means that you then look more like flat ones on the left, and then more on the steeper curve down on the right. And kurtosis of raw returns of all financial markets larger than 3, indicating a flat tail. So which means that it's more like that, like there was a huge distributions ranging from very low to very high. And quartile plots, the points to the 2 plots for approximately among the 45-degree reference line, which means that the 2 sets of sample data in one QQ plot come from the same distribution. After comparing with the empirical results summarized in real stock markets, our model matches several financial markets within a reasonable range. So before we do any analysis, we train as if like the real market, we train the system to be able to respond like the real market, and we then also identify those summary as what I have presented earlier. And then after learning the market's behavior, then we begin to do the analysis. And so the result of the survival noise traders. And as you can notice, when the proportion of the noise proportion goes up, they tend to stay for a longer period. And if the percentage of noise trader will be small, they cannot survive for too long. And this is tested by our empirical result. And also, the part 2 of this research shows that the changes of wealth level over time for 3 types of traders. As you can see, when time goes by, the majority of the noise traders will become bankrupt or they're losing, whereas the differences between informed and uninformed traders are not so significant. And then to a certain extent, informed traders will only show the advantages of the wealth level when time goes by. At the very beginning, the differences were very small. And other experiment of different distributions of traders also provide similar pictures of the following figure. Then we then investigate on the impacts of the market part and impact of noise traders on the price dynamics. The price fluctuation becomes more significant when the noise ratio increases and the rise peak under 90% noise ratio from a minimum 8.2 to a maximum of 63.5. So as you can see, when time goes by and towards the end, the noise traders will lose most of the money. But at a certain period of time, they also gain. But the issue is that they may not maintain the profits, and eventually they may, not all of them, but quite a significant percentage of them will lose the money that they already gained early on. So this shows that it's the reason that they may not maintain the wealth in the long term. And also, results of the impact on the market show that the impact of noise traders on volatility. Now we want to know if the percentage of the noise traders goes up, what happened to the volatility? As you can see, volatility is another word for the market risk. Therefore, the market risk will also goes up when there are more noise traders, because it means that their behaviors and decisions are unpredictable. It can be very rational, very unrational and sentimental based. Therefore, it then increases the predictions and also the stability of the volatility of the market and the impact of the noise traders on the noise trader risk. It reveals that the noise traders help increase noise trader risk. And as you can see that it then goes up. It may not necessarily in a linear regression, but sometimes will go up to a certain level. It depends on which countries, which type of industries you're investing, and also it depends on the stock, the performance. The individual stock performance also vary. And then but you can see that when time goes by, the risk is always goes up. And the impact of the noise traders on the distortion, the price distortion increases on average as noise traders become more. And then the impact of noise traders on the trading volume. As we can see, the trading volume in the market increases as noise trading increases. As you can see, it then goes up with the trading volume to some extent, and then it has a very similar trend. And then an average trading volume given rise by each noise. Informed and uninformed traders in the market increases as the noise trader increases. So when they see there's an increase in trading volume, so all three groups probably put in more money, or maybe they sell it off. But then, as you can see, the noise traders, they are very willing to even invest more or sell more when time goes by, or when the market shows a momentum of going up or going down. Then the profits analysis, as we can see, both informed and uninformed traders earn profit from noise traders, and the informed traders do better. And in fact, the differences are not that significant. But as you know, in finance and economics, whether you believe or not, someone's gain is someone's loss, someone's loss is someone's gain. So therefore, most of the noise traders, when you are doing a very long-term investment, they are losing. And that was because the informed traders and as well as the uninformed traders earn from the transaction. They earn more on average when the proportion of a noise trader increases. And also on a regulatory intervention, 10% price limit, because most of the government, they would like the market to be an open market as well as with a regulation in place, because they don't want any investors to invest too much and being out of control. So 10% price limit can be a recommended range, not too high, not too low, as explained earlier. The noise traders' survival period shortened on average by imposing the price limit. If the price limit is limited, as you can see, that they actually will have been affected by the profits they have. So the noise traders lose all the wealth after 14,000 periods when 90% of noise traders are in the market. So if there are too many noise traders, it means the market become very unrational and very sentimental based. Therefore, people may lose all the correct decisions, and they thinking less in logics. However, they shorten the period to 10,000 in the market within the price limit. So it means that for noise traders, they may have a better chance of success if they do a short term and then leave out the market completely. The right figure shows the average number of price hits resulted from all the traders' expectation for each period. We find that the number of limit hits significantly increases as the noise traders become more. Imposing 10% price limit may make the bid-ask range be narrower, and also other traders then have more opportunities to make the deal in the market. Hence, the noise traders lose all the value and are driven out of the market faster. So when time goes by, it is not a very good strategy for noise traders to stay, because they are more likely to be hit by certain investing strategy or even a speculation, because there are some private investors. They have lots of fun. They can even drive the way the market go, and they can sell at a time that is very unpredictable. Therefore, it is not wise for the noise traders to stay for too long. And then the regulatory intervention, the 10% price limit, the noise trader risk volatility reduces when imposing a 10% price limit in a way that they may safeguard to noise traders to some extent, because it's going to prevent the volatility to go too high or out of control. The price distortion increases when imposing 10% price limit, and the trading volume is non-stationary when imposing a 10% price limit. As you see that, even when you impose that, people may have a different behavior at the beginning, more conservative, but towards the middle or even towards the end of the trading period, they may become more freestyle, and the trading volumes are quite low when the noise trader proportion is less than 30% in the market. With a price limit, trading volume increases when there are more noise traders. So the reason is that a lot of investors, they are thinking and waiting for the right moment, and they usually wait for the right moment to strike. Therefore, they reserve all the energy, and in order to make a profit, they wait for the better moment or better movement when you are on the way up, or about you are on the way up, or you are going to sell before it's on the way down. And they are not like investing or like buying and selling at any time. They think more like a team with a strategy, with collaboration, and so on. So as we can see, the noise traders are driven out of the market more quickly when consider the tax in the market, because when there is a tax, usually those investors with fund, they can show more advantages in there. Therefore, noise traders seem to be hit by that. And it's also a way for the government or any financial market, if they want to manage the number of noise traders to a certain extent, they may have to impose certain tax. And as you see, the noise traders are driven out of the market more quickly when we consider the tax in the market. And we cannot clearly find a monotonic relationship between the noise trader risk and the degree of noise proportion in the market. The reason, even when we run all the simulations, because we know that the percentage of noise traders are random. We cannot predict. They may be usually driven by some speculation. Oh, this company is going to make a profit. So let's say like Apple, they are going to make a huge profit. And usually you notice that 2 weeks before, or even 1 week before the news, and a lot of people are start buying. And this is how people catches the signal and they begin their action in advance. And actually, you will also notice that on the day they announce the outcome, it's not necessarily making a profit. It might be the other way around. People are eager to sell them off. And you may also notice that on the day of release, or after 1 or 2 days of the release, that actually the prices are going down. Therefore, we cannot determine when the noise traders comes in. However, the market volatility is also not clearly and significantly influenced by imposing the transaction tax, because as you know, it's not going to stop private investors, because for them, they have lots of fun. They really even don't mind. In fact, sometimes they like that because they can prevent certain number of percentages of the noise traders to come into the market to interrupt their trading strategy. And price distortion is slightly increasing by imposing the transaction tax. the trading volume increases by imposing the transaction tax. As you can see, all the simulations means that we have the without tax, we tax and standard deviation. Standard deviation tax on average, but then you can notice that some they behave very similar, some they are very different, and therefore it really doesn't make any difference for the private investors. As you can see, the regulatory intervention, if we finish all the transactions within the same day or with 1 day, widening the settlement cycle from 0 to 1 helps noise traders survive in a longer period. In other words, noise traders are trimming out of the market more quickly when we employ T+0, which means that all transactions have to be finished in a day. Usually it was because they don't have too much money, they have to wait for the money to get settled, or maybe when they get the money, they are more satisfied with their profits, for instance, and they don't want to make for the next cycle, because we cannot predict the time that noise traders will come into the market. Therefore, it then stops them. And if you have a day in place, they can actually stay in the market for a while and understand whether they want to continue investment or not. And as we can see, the regulatory intervention, we're widening the settlement cycle from T+0 to T+1 that helps to reduce the noise trader risk and market volatility, especially when there are more noise traders. And price distortion increases by widening the settlement cycle from T+0 to T+1. Shortening the settlement cycle increases the market trading volume, no matter how many noise traders are in the market. So there are certain things that have changed, certain things are not changed. As we can see, what is not changed is that no matter how many noise traders are, settlement cycle increases the market trading volume. And also the prices may be changed, because with the day difference, some noise trader may still stay in the market and hope that they will they make the next investment or not. And if you settle the transaction on the same day, they probably may leave the market and so. So sensitivity analysis. We also perform the sensitivity analysis to investigate how the findings are sensitive to the parameters of the simulated model, because we need to know how the market may respond to certain changes. And we perform the analysis by considering different parameters, such as the initial wealth of each trader and the learning behavior of informed and uninformed traders, probability, combination of mutation, and crossover in a genetic programming. So in a genetic programming, we then can see what the changes are. When we change the parameters, we then can see the outcomes more quickly. This will involve with the initial wealth of each trader, so those with more versus those with less, and also the way that they behave. Like we notice that in most of the cases, informed and uninformed traders, they seem to think and behave in a similar way, with a slightly more profits from informed traders. But however, we also want to know the probability in which they may change their decision and behavior. We test whether the results of volatility and price distortion are influenced by the change of those chosen parameters of the model. We find that the results do not have significantly differ from those observed in the calibrated model, indicating that noise traders increases volatility and price distortion. So when we run a simulation over again and again, we notice that noise traders, they usually behave in a very similar manner. It really doesn't matter which country you are from or their backgrounds. They usually, if the percentage of them goes in the market, it will then increase the volatility and even change the way that the market will behave. So some of the example may also include gold prices, oil prices at a certain period of time, and also some stock, especially like well-known stocks, or like some stocks of the as being regarded as a rising star, or maybe some stock has been disseminated very actively on social media, and some bloggers have been talking about all of them all at the same time. So really, the thing is that we have to be skilled in terms of understanding what to invest and when to make a decision, and so that we then have a better strategy for this. It's not just out of any sentiment or out of the sudden change in the market movement. And the implication is that the 10% price limit contributions to limit noise trading, as it helps reduce noise trader risk and volatility. Informed and uninformed traders have more opportunities to make money from a shorter range, and then the noise traders cannot survive extended period with a 10% price limit. We're not trying to say you should do that, but from our simulation, it shows that the noise trader cannot survive for long term, which means that the problem with noise traders is that when they make the first profit, they are usually in a hype. Oh, they are going to make more. But when a short distance running, you may be winning. But then when it become a marathon, you are losing. And therefore, 10% price limit may try to discourage to some extent, but it's not going to help with the final outcomes. The imposition of the transaction tax slightly increases the price distortion while decreasing the trading volume. The noise traders are driven out of the market more quickly when we consider tax in the market. When we widen the settlement cycle from T+0 to T+1, we find that the noise trader risk, volatility, and trading volume significantly reduce. T+1 also diminishes the ability of informed and uninformed traders to finish their trading in a short period. In this way, it reduces the market efficiency. So, in a way that the settlement doesn't seem to have a huge impact on the informed and uninformed traders. However, it then means that their trading behavior will be changed from a long term become a short term. Therefore, doing that too much is also not good, because we would prefer a wide variety of investors. Not all investors are doing short term. Not all investors doing long term. And when if you are in a government body, or you are helping the government to set regulation, you have to consider all those consequences. And so the effects of different regulation on noise traders or the financial stock markets are significant distinguishing. For example, price limit, transaction tax, and T+1 settlement cycle might be imposed into a stock market if regulators aim to lower the proportion of the noise traders. However, regulator may not consider imposing price limit when they aim to improve market efficiency. Therefore, regulators should make appropriate regulation deliberately to achieve specific different policy goals. Which means that what is more important is that before we consider to make the regulations and any policies, we should really look into all different types of data analysis. We should simulate and understand the impacts to the market before we make the decision on the regulation or before we recommending them, because the market can be volatile, changes can be dynamic and very spontaneous. Therefore, we should actually use the data analysis with advanced skills more to make the decision better. So if you can please visit our paper, because our research contributions are even much more than what the paper will be offered. And please remember that there are some aspects of the paper can be very theoretically based, but then the key messages are being delivered today. I hope that it's going to help you in the long term when you're doing the investment, or at least will help you to gain some knowledge and insight. And the paper is free forever. Yes, it's free forever. Please cite or consider citing if you find it useful, relevant, or inspiring. Many thanks in advance. And as we also have stated the 4 major contributions we have, and I hope that you enjoy the talk and also enjoy reading. Thank you so much, and we wish you all the best. Thank you.